Denison, thank you so much. Far too kind introduction, but nevertheless, I thank you. Good afternoon, good evening, good morning, wherever you are. Hello, everybody. Welcome to this BTRM guest webinar, which we're going to talk about making sense of macroeconomic indicators. And if ever there was a topic that has kept people engaged for the last, since the end of the war, really, or since the 19th century, it is what do we make of all the various indicators that come out published daily? There's the obvious ones, base rate, GDP, inflation, unemployment, non-farm payrolls, etc., trade figures, etc. They're coming in one ear and out the other, and I'm just talking about myself here. So rather than me rabbit on about that, I'm going to introduce our guest presenter for today, Mr. Patrick Reid, who me and him go back a few years, although I don't believe we've actually met in person. So that's the beauty and the wonder of social media. But he is a prolific commentator on social media, and he is, well, if there's anyone who knows how to interpret or make sense of macroeconomic indicators, it is Mr. Reid, because he trades it for a living. It's his bread and butter. Okay, so if there's someone whose opinion I would value, it would be his. So I'm going to hand over to Mr. Reid. He'll then take it from there. We'll go through this presentation. There will be time for Q&A, as you heard from Mr. Denison. We'll open up the mics at that point. Feel free to write anything in the chat. I can moderate that as well and pass them along. As Ed just mentioned, Patrick may well address anything that comes up in the chat as well. So feel free to type away, and then we'll have Q&A at the end. But in the meantime, before we get to that, I am going to pass on to Patrick. Patrick, thank you very much. Welcome, sir. Thank you for giving up your time to present on behalf of BTRM today. And this is something I myself have got a few questions on, so we'll save them for later. But sir, all yours. Let's go through your presentation, and I'm looking forward to hearing this. Thank you very much, sir.
Thank you, Murad. What a warm welcome, and thank you. It's a privilege for me to be here. And I have a wiggledy-piggledy career path. I'm a late career change. I'm co-founder of the Damage Principle, and my business partner Adam, he's been in sales and FX spot trading for 35 years. I've been around 15 odd years, started out in the futures desk and learned when I was quite old, really 38 years old, and I learned desk macro. And really what this is about is desk macro, tradable macro. It's not the kind of the other stuff, which is, I would say, economic macro. I know it sounds a bit odd, but that's how I was taught it, as a trader who went in with my own money, the cut and thrust of the desk, eating, what I killed basically as a local. And I was among a lot of ex-live floor traders and a few Chicago pit traders. So that's really where I cut my teeth in the Bund pit at the biggest futures desk in Europe, Tower Trading. And really, I don't know any other way. So that's my angle. That's my kink. That's my view on the world, and it's good and bad, but really what this is about today is just my story and the way I view macro, and really it's essentially not what it's a very good filter, and it's not perhaps what you'll see in the headlines of our news outlets. Right, so some of it I can discount very quickly, and it only works for me. And really, this is what that is. So I was looking at the different things I filter out, what I use, what I don't use, and I've got three sort of things. So hopefully it's going to be fun, and please do ask any questions. We'll leave some questions at the end as well. So with that in mind, let's get to the presentation. So this is really tradable macro and macro indicators. These are things that I use and I still use today. Okay. Now the agenda, what we've got is how to make sense of macro. It's all about the reaction function. Now, obviously, you hear about the Federal Reserve's reaction function. This is my own kind of take on that concept, and I do that, and it was taught by me by the kind of spit and sawdust desk macro futures traders, and basically The reaction function in it, just to set the scene, and I'll be mentioning this a lot, it's within the context of macro comes out, how much is that move? How sustainable is that move? And how long is that move in cross assets? The optics is FX, but we look at everything, right? And that's in constant flux. So the power, the leaderboard of macro is based on that framework, essentially. And now, the reason I'm telling you this is I used to day trade data, mainly US, and record everything for many, many years on the moves with, say, CPI or PCE or GDP or wages or whatever the hard macro is, and then look at the hard data and then look at the soft data too, like your ISMs, your PMIs, yeah? So really, that is my framework, and that's the only framework I know. Obviously, there's lots of other stuff. We look at the holistic risk, and we look at lagging and leading indicators, but really we're looking for the torque, the where the rubber hits the road. And sometimes you hear about things being ahead and behind the curve. Sometimes you feel the market got the memo late, you know, and things like this, and that is always kind of ebbing and flowing within the key bits of data and the key bits of macro. So we're going to talk about a bit about that. And then the second thing is what happens after a vol explosion. Now, I don't need to tell everyone about the carry unwind, right? So we're going to talk about that and why having a framework is key. Now, from day one, I was absolutely pummeled into thinking, into insisting that risk management is the number one quality, and good risk managers can be average at macro, can be all right at technicals, but if they're really good at risk management, they're going to be consistent, profitable traders. You can't flip that the other way around. I know exceptional macro traders, you know, friends of mine, ex-Goldman guys on pre-GFC prop at Goldman's, remarkable, but their risk let them down, right? So that's the key thing. So with that in mind, having a framework, whether you're right or wrong, is something I was told from day one. So that's the second thing. So, you know, we're going to talk about this 20 big figure move in dollar yen. We're going to be talking about how the baton moved from the first 10 figures in dollar yen across the crosses on the yen, and then that moving into the bond structure, and then that moving it into, last but not least, the equity structure. We had that Asian crash, then we had that bounce on the Monday. So it's just talking about things like that, and the why is so important as well. Why did it move like that? Why did it move like that? Okay, and what next? That's the kind of thing. And framework, even if it's wrong, is key, because you can really be sucking into be buying in these dollar yen dips, and it could go on and on. So there's that. And the final thing, just really quickly, is hedging starts before derivatives. And I have to say, as a futures trader, I used to look at all assets. I've traded short end. I've traded Eurodollar futures. I've traded bonds. I've traded all the T-note, gilt, Bunds. That Bund was my first week in the Bund pit. I traded FX. That was my love, really. But I've also traded commodities as well, and equities, indices. So I kind of had to look at everything anyway, and I was like, oh, this is amazing, but I really started gravitating towards FX. So your usual G7s, right? And really, what I learned, and then after futures going into spot, I learned about crosses, and I learned about relative value, RV trades in crosses, and I learned about the power of the cross, the dynamics of the cross, and what made the cross. And I also was told crosses do not exist, which is bizarre. Well, first thing they're saying, use a framework, even if it's wrong. And then the second thing they're telling me is crosses don't exist, like euro yen doesn't exist. And then I learned why they said that. I learned they said that because it's the derivative of two core legs. And if you've got a level in the cross, you have to have levels in the core. but level in the cross doesn't exist, and that really got me thinking. And then the power of the cross and the ratio, and I don't want to go into that too much, but crosses are so important. And the reason I'm saying this, reason I'm sort of labouring on this point, is the final thing: hedging starts before derivatives. When you think about hedging out risk as a corporate, as a bank, as a client, as a hedge fund, you think about FX options, you think about forwards, right? You think about swaps, right? But there's so much more before you get to pulling those triggers that can be expensive, and that is the quality of the macro and the tradable macro based on the reaction function into that. So you pour in the quality macro, you get a view, right? And then you get a timeline, and then before that you can start using the crosses. Crosses are brilliant to hedge out risk. So we're going to do a little bit of a fun game towards the end of this masterclass, and really I love this. That's one of my best bits. So yeah, so that's it really. And please do any time. If I missed a few texts there, but if you do want to chip in at any time, just put a text in there, and I'll leave some time at the end for Q&A. So I get a quick question. Can you type in the chat from 1 to 10? What is your current level? What is your current knowledge of tradable macro? But 1 being the worst and 10 being the best. I know Murad's going to go 10 because he's just very clever. 5, oh, I love it. 10, I knew it. 5, Claire, 5, very good figure. I like that. I'm about 5. 8, Jill, well, excellent. Ismail, 5. Couple of 5s there. 6, nice. Okay. Andrew, 2. We're going to get that up to a 6. I promise. Marcello, 4.75. I love it. Is that some kind of standard deviation? That's brilliant. I love this. Okay, that gives me a good level to see where what level we're gonna do. But I'm gonna lift everyone up, hopefully. I love it. And we might get more up to an 11. How about that? That's gonna be turn up to 11. Okay. All right. So let's get on with it. Here we go. So I like basic. I like simple, and really risk for me was said to me in a very simple way. It's about debt, it's about interest rates, about yield, about carry, and this is just a little thing that I like to give my clients and like to kind of start. So excuse me, it's a little cheat sheet. I'm just going to take some water. It's a little cheat sheet of interest rates. So what happens when yields go higher? Currency goes higher, borrowing costs go higher. Savers do it too much, it slows growth, hurts businesses, and then the flip, and that goes lower. You can over-egg that, can't you? And obviously, you all know this, but it's just when you see it in black and white, and you see that here on the desk, it's just quite something that I've been doing this around 15 years, and something I forget. And I love this concept. Serge, who used to run spot at HSBC, he taught me my first kind of spot trading, and he said, everyone needs debt. Debt's wonderful, right? I mean, that's quite controversial, but I realised, we live in a leverage world. You can't lever up certain assets, but you can with fiat, right? So it's good. If we didn't leverage, we didn't borrow, I don't know where the world would be, right? And that's another thing I was told. So everyone needs it, from Buffett to the shopkeeper. Secondly, debt has a price. Thirdly, that price affects everything we do in life. And if we can understand debt, you could probably say we can understand life. It's a bit of a bold statement, yeah, but I do believe it, and really I thought it made me view markets in a really and macro in a really special way. All right, so here we go. So really, as I said in the beginning, it's about the reaction. Record that move on the data. That's how powerful it is. Everything else is not important, right? So record the reaction function. That's how you make sense of macro. I'll give you a little topical thing. The Fed, right? The Fed, the wonderful Fed, has in a certain amount of words, told us that inflation is friendly in the US, right? So that means we're not bothered about inflation, right? As a trader, that's tradable macro. That's reaction function, down, down. If it's friendly, it's not really going to move it, right? So yeah, we've recently had a CPI come out. It had a bit of a strange move, but it was a nothing move, right? Largely in line, right? Delta was 0.1 on the core on year, nothing much, right? When inflation was really sticky, I know services inflation is pretty sticky, but when core and headline inflation year on year was sticky, that's when everyone was trading it. You know, you had a 0.2 move out, a cumulative 0.2 move out, and euro dollar would be going 150 pips, which is a decent move. And then, you know, dollar yen would be going 200 pips. And some, you know, having that. But really, I only know this because I've been recording those moves for for well over a decade. So really, if you want to make sense of the macro, it's understand the desk macro and what's tradable and what isn't. The bigger the move, the bigger the risk, and the bigger the importance of that risk. Record the reaction function, right? That's how you make sense of it. Now, remember, the market is always trying to tell you something. All you have to do is listen. I like to use this one and that one, and I like to do that. And that's another thing I've got to learn in the first month of trading. Futures, Bund, 2 ears, 1 mouth. And I wasn't told that in a nice way, I'm telling you. It was a few swear words, I have to be honest. But I very quickly learned that I needed to just listen to what the market is saying. And the great thing about this framework, this concept of reaction function, is if the market doesn't react to data where it should be, because you know how much it should be moving, you know that no one wants it, or you know it's late to the memo, or a mix of both, or it could be dollar positioning, could be so you're questioning everything. I'll give you another example. We had you know, markets do create their own reality as well. So take jobs, right? So obviously there was this, the market shifting from, you know, just to backtrack, you know, a largely pristine macro picture in the US, come off the boil, still sticky inflation, that's got friendly. Now we shift to jobs. We have the SAR move getting triggered, but it was supply driven. That's the why. Right? It wasn't demand, it was supply. It did trigger, but it wasn't recessionary. You know, I'm very lucky to have a couple of DMs with Claudia Sam, and her posts are amazing. They've really blown my knowledge into another widescreen level. It's incredible. And you know, Claudia Sam herself has said it wasn't a recession indicator, but nonetheless, it got triggered. You know, we do like having this silver bullet. One indicator to say that's the reason why this, you know, it's like the 2s 10s inverting. No, you've got to look at everything, right? And that's what I say. So just recently, before non-farm, we had jolts, right? Last week we had jolts, second tier data, it moved dollar, right? That was just before non-farm. So the market was taking second tier data, going to the reaction function and get a reaction function and going, that's a bellwether for non-farm payroll. Dollar was positioned and wanting to sell dollar into non-farm that wasn't so bad. So therefore, that affected the trade and the move on non-farm. This is all about the reaction. All right. So if you can get this right, you can really understand risk, and you can understand your what's good in macro indicator wise and what's bad. Okay. So some of the things I look at as well, hard and soft data, we all need a bit of both. Hard data is realized, as you know, it's lagging, it's rear view. It's happened, right? So that alone is not good enough. You mix it up with a lovely bit of ISM. Forward, you look at prices paid on the component of ISM, amazing. It's inflationary, yeah? Especially when inflation was sticky in the US. If you look at prices paid on ISM, you know, these are great little indicators that I use often. We look at rates from the massively short end to the long end. I feel on the treasury curve, I always quite like to go to my 2-year on weekly, and I've got big levels that I draw for myself, and I use that as a kind of metric to see where dollar's going. Obviously, rates, dollar follows rates, right? But also look at the differentials as well with Europe and the UK. So that's another thing I sort of look at. One thing I did do is next week I'm doing the Trade Tech event in Amsterdam. I'm my moderator, and we were on a discussion panel just before this week, just to talk about the questions. And I was talking to some pretty big real money asset managers, and one of them said it's not about the macro, it's pure positioning, and that really kind of made me think, wow, that's important. That's really important, because sometimes macro will come in and be a massive beat or a massive miss. Dollar's not moving. Why is that? Because it's positioning. Could be late to the memo, obviously, but it's not moving. So dollar position is really something I really look at. Okay, and the other thing is, what moves today may not move tomorrow. Just be nimble, be fluid. All right. The bigger the move, the bigger the risk. So we had a remarkable carry unwind if it was a risk off carry unwind without a risk off event. Yeah. So, and the other thing, and the final thing, which is something that's really saved my bacon over the years and actually made me profit a lot, was emerging markets. We call them berries in the coal mine. Often, I've been very lucky to work alongside some top emerging market traders. Just unpicking how they work, what they, and if you look at broad EM as a measurement of risk, it's just exceptional. You've got very wide spreads. You've got incredibly positive carry. So if you're buying dollar against EM, you're getting hit on negative carry every single day. You've got to be really positive, as is new in your market view. You've got some not very good governments who will manipulate things. In South Africa, for example, I'm not saying that's the manipulating government, but you've got ESCOMs, you've got debt, you've got lots of these different things. You've got emergency overnight swaps that get thrown at you, like Turkey, 1,000% overnight. That's going to kick you out of your position. All of these things EM traders have to kind of tackle, plus the dollar, plus the macro on the US side. So all of this stuff, what I would say is the key EM currencies I look at are Rand, MEX, TRY, Ruble, Korean Won, and CNH. So if you see a pattern in EM and it's going north, saying dollar is bid to boots, going north against all those currencies, and it's going the opposite in DM, G7, I would tend to believe EM, because it's costing them more negative carry. So that's another thing. If you see, it's a bit like, if you're looking at credit spreads, you see some unusual action, but EM is a really good clue. So I would always ask EM for clues. That's the final thing on that slide. Okay. So this is a list of macro inputs and macro indicators that I really like to use. Now, it's not a definitive list, it's my list, and it's based on a reaction function. And I really like it, and these things are always going to be in my toolbox. I mean, the Samuel's kind of recent thing. I do always been trading ISMs. I think they're wonderful. At the moment, it's jobs over inflation, as you know. I really like things like Trueflation. It's not in this list, but I do like Trueflation just as a kind of temperature. Atlantic GDP, really nice. Kansas, that's been a massive focus for me. It's been, there's a guy called Brent Donnelly who kind of brought me onto that as well. And it was the real temperature of jobs way before the SARMA got triggered, way before a lot of things people were worried about that, right? So the Kansas City Index, Labour Activity Index, that's something. The Treasury curve, the short end on the weekly, as I said, absolutely fantastic. OIS, software, Eurodollar futures. I've slashed those. I not very well. I did trade Eurodollar futures for a brief time, but I used to love LIBOR. I used to love, anything in 3-month tenor with interest rates, and really things like Eurodollar futures or LIBOR or software, stuff like that in the 3 months. I actually prefer that to an OIS structure, but I do like to look at all of it. There's a great company called Chatham House, which that's a reveal, by the way. That's where I get my software from, because I don't have Bloomberg at the moment. Yeah, I'm kind of. I used to use Bloomberg a lot, but it's just something that that they give out a lot of the software terms. So it's really good to get a mix of all of it. And I would say, being someone who used to love offshore dollar and looking into the whole amazing Eurodollar market and the history and all that, I was fascinated with it. Actually fascinated. It's something I discussed at length with Chris, who used to trade for the Bank of England spot. He's now gone to the crypto, the dark side, basically. But he's a good guy. I used to go over to see him at the Bank of England, and we have many historical chats about the Euro market. Incredible. I mean, it is definitely like the Matrix. No one can really gauge how big it is. You can only guess. But without it, it's invisible, it's around us, but without it, the whole world's going to fall apart, basically. So from then on, I need to know more about it, right? So that's how I work. Obviously, credit spreads, right? So there's a great, prior to Christine Lagarde, today, there's a great thing on John Author's daily Bloomberg post about, the Draghi, whatever it takes. Now, I was around that time, I was very much involved in the periphery bonds and obviously FX. So that was a great time to trade. It was tricky, but it was a great time to trade. Around 2011, 2012, credit spreads calmed down on those verbal intervention words. They really did calm down, and also sovereign spreads too. They relaxed. So, and then the final thing I really love is financial conditions index. It's a bit of a beast component wise, and when you list up the components, there's obviously your usual spreads. There's mortgage. There's jumbos. There's a lot of stuff in that. Don't get overwhelmed. I mean, I'm sure many of you know this already, but when I first saw that list, I was like, I need to sit down. This is just, I loved it. I love being overwhelmed and just diving into a new subject. So I looked at all the components of the SCI, and I was like, well, hold on. There's the Chicago and there's the Goldman's version. How do they differ? Which is better? Which is worse? And I really dug into that. But any kind of conditions index, obviously they have interest rates, they have the treasury curve, they have mortgage applications, all that stuff. So that's the other thing I really look at. And I look at a lot of other stuff, but really these are my top 9 that kind of move up and down in priority. These aren't in priority right now, by the way, but they move up and down priority, and I just love them. And they're very fresh right here, right now. Sometimes one will get left behind, but an old one will come back. Remember I talked about the JOLTS thing? Initial jobless claims, JOLTS. These are kind of more noisy tier 2 data. But if we're looking at non-farm, looking at wages, unemployment, and these little things will be getting more warm, and maybe they'll be coming into my list. But I would just say, look, keep it fluid. Don't fall in love with an indicator, fall in like, and always be prepared to say goodbye. It's like having a good friend sometimes you've got to let them go because they're just not really fulfilling you in loyalty or reliability, so to speak. So that's how I view that. So and this is a list of things I don't use, right? About 12 years ago, I tried to trade the debt ceiling, and I lost a lot of money. So I don't do that anymore. US debt, you can see this big fat number ticking along. For me, I ignore it, right or wrongly. Yes, you can see it, and it's those big baddies getting into lots of debt that they can't pay back. But the key thing for me is who's going to say no to the T note, right? So what I do is I used to trade auctions, treasury note auctions, bid to covers, and that's how I really got a sense. When I looked at the roll-offs, the expiries of the 10-year, I would say ignore the other tenors. 10-year T note is the main one, right, on the US side. So when that appetite starts to wane, I think you'll get some kind of potential moves from the bond vigilantes, and that's another kind of conversation, not for today, but you'll get some kind of move. So if there's the appetite starts to wane on a consistent level, that's when the debt starts to be questioned. But essentially, as a whole of the global reserve, the US, it has to issue dollars. It has to keep the world liquid. Everyone needs dollars, as you know. So therefore, there's always a residual appetite to buy US debt. It's risk-free. It's what else can you buy that needs balance in your portfolio, right? So all of this stuff, that's why I largely ignore the debt kind of issue. Balance of payments, not an issue for me. Hard data with GDP, rear view, sometimes that comes in, it's a little bit laggy for me, but it's in, it's out. Home sales, anything with homes in, I don't get. The beige book, very interesting, but I can't trade it, all right? And then the other thing I did, and I do this, I shut myself off in my office or whatever. I just go really into all of the quality agencies and reports that go into one bit of macro. So I did this on CPI and the relation with that PCE, the Fed's metric, right, preferred metric. And I really got stuck on OER. This is owner's equivalent rent. It's a big fat variable. It's very hard to gauge, and it's a bizarre concept, right? It may be completely clear to people here, esteemed people here, but for me, it's like, how do you work that out? So therefore, any splits on CPI, I just couldn't trade. So that's just something that personally is my personal kind of choice. Okay. Just to recap on this, as I said, remember, nothing lasts forever. Fall in line with the reaction function, never fall in love. Heartless, isn't it? I know. The bigger the reaction, the bigger the risk. Treat the reaction like a yield on a bond. EM looks attractive in carry, but that comes with more risk. I was having this Argentinian, I've never been to Argentina, but I absolutely definitely want to go. It's very beautiful. But at one point they were offering 60% carry on the bonds. So I'm thinking, okay, attractive, or is it? That tells you a lot, all right? So it should all of this stuff really should be factored into all kinds of risks, especially balance sheet risk, all right? Okay. Now the second bit on the agenda, what happens after a vol explosion? And we're doing a bit of a case study with Japan and the carry unwind. For me, it was phenomenal. My clients did really well out of it, only because of the tradable, the reaction function, the tradable aspect of the macro, and also why it was moving and where it came from as well. So, we had a 20 big figure move. It was a proper unwind. It lasted, it went from $160 yen to 140-ish. And I would just say, for me, framework is key to survive this. So it's working out the why. We were tracking this on the way up, and essentially when we were tracking this on the way up, we were looking at the reaction on dollar yen, which is highly correlated with 10-year and S&P after, say, a miss on US macro. The bounce would be shallow and it would go above and beyond that. And that was largely CTA funds with positive carry. It was absolutely not light in our eyes. So to top it, you had the MOF against you intervening, right? With a large amount of money. So for a while, it just didn't stop, especially at the beginning of this year. So that was something with red flags for us. So we were noticing that and preparing for something bad to happen. So essentially, there were a number of triggers that caused the carry unwind. No one, I've spoken to a lot of fairly senior people, no one really knows the actual trigger. Weaker jobs, it was the SARM rule, it was this, it was that. It was a bit of everything, and no one really knows what pebble caused the avalanche. That's what I always say. Okay, so the important thing is, if you get a risk-off event, and it was a risk-off move in dollar yen, but it wasn't risk-off, right? So from yen to bonds to equities, that was the final thing. Remember the Asian crash, and then on the Monday, Goose will be coming in, trying to calm everything down, and then we have that bounce, right? So all of that's recorded. Asian crashes often get a bounce in London at the open on the Monday. This is what a reaction function can do for you, for your intel, right? So we were prepared for that. So the top advice I would say is create and use a process-driven framework, even if it's wrong. Work out the why and what the gears look like, right? And you saw that in the build up, and then you can effectively trade it and manage your risk on the way down as well. In this case, we were looking at the 10 big figure before the crash in Asia. The pattern was yen, then bonds, and lastly equity. So you've got your map. This crazy Monday, that's when things bounce. And then, does that change the Fed's mandate? No, people talk about the Fed put, the unofficial mandate is stability, not in price, but market stability, liquidity. But it's not in their mandate, really. Then you had a carry unwind. What next? We might be on the verge of maybe a potentially third carry unwind. Who knows? So really, these are the things that are really running in my mind. And then this is my vol explosion framework. When to get back in, or should I expect, calm? This is what I use, and there's no right and wrong in this. Own it, use it for you, and that is what I would say is, and some of that is calling my spot trader friends. I call him my old futures desk, going, yeah, what are you guys doing? Just as a chat, because I know them all, and we go for coffee or whatever, yeah. So at the end of the day, this is what I do, wait for dollar yen vol to retrace, and we go through dollar yen FX vol, we trace half the breakout, all right, so you look at the heart, I think it went to 12 or 17 or something, I can't remember, but if it goes to half of that, wait for 3 bars on the 4 hour in 12 hours for consolidation. Check the cross assets on reversing. What are those? S&P. High beta currencies like Aussie and CAD, are they getting lifted? Again, back test Monday in London post Asia crash. This has happened quite a few times. We often see a bounce in risk. So that's my little framework for when to get back in or not. If all of these are met, you get back in. It doesn't matter if you're wrong. What you don't do is use your gut instinct, right? And there's a little bit of that. You can't get away from that, but really you can't be doing that when you're in a high volatile market. It's so important just to keep sticking on those rules. All right, so the final thing, God, it's whizzing by. It's 41 minutes. I'm going to wrap this up very soon for Q&A. This is my, really love this. The hedging before derivatives, you can hedge out with forwards and swaps and all the rest, but you also hedge out with crosses, RV, right? So here's a question for everyone. Aussie CAD, what will be the risk in trading Aussie CAD? Can you list them? If you pop it in the chat, and then I'll ask the same questions, but without the risk. Can anyone see? If you're buying Aussie CAD or you're selling Aussie CAD, what is your risk? What are the risks around that RV, that crosses pair? Don't be shy. Well, you are shy, aren't you? Oh well, never mind. Okay, so Aussie CAD, some of the risks in that are China, macro, geopolitics, risk off, risk on, potentially. We'll come to that in a sec. Oil risk, but interest rate risk and central bank risk. You haven't got dollar risk. Isn't that important? So just anything on the dollar side you haven't got, right? So that's just important. And obviously you can do this by hedging. You can use these by if you want a hedge that's cost effective. It's not fancy or sexy. It's not like an FX option or a swap or a forward, but it's certainly something you can do. You can buy and sell different dollars in different gears. You can hedge out. If you've got a very long dollar position, you can have some short euro yen and Aussie yen positions to hedge out some of that risk on the yen side. So these are just some of the things I quite like having fun with. So that really is the quality of macro on the reaction function. Knowing how dollars positioned, looking at your hard and soft datas, and then looking at your crosses. If you're going to get involved, before you start to pull the trigger on derivatives and FX options and such like, you may not have to, right? You may do it, but that if you do that, it will be a better option. It'll be a better execution because you'll have that quality that you poured into. That the market's fritting about, that the market hasn't priced in, or the market is currently pricing in. We took a call this morning on the ECB, and by and large it was a non-event, but we kind of expected that. It's all about will they, won't they, October. Well, that's not going to happen. So yeah, these are just some of the things, and really, I would just say those three things. There are many more things we can cover, but those three things are really saved my bacon and given me a great consistent track record, and I love them, and I'm constantly learning, by the way. So that is just the final kind of recap on the RV currency, and sometimes this is just a little bit of a cheat sheet. You've got euro sterling and some of the dynamics here that I'll leave with Morad and everyone, so you can just sort of have a look at that. But you know what? I am now 10 seconds away from Q&A. It's the final slide, and all I can say is thank you very much, and that is it. Any Q&A, please?
Mr. Reid, thank you so much. Thank you so much. There's a fair bit of jargon in there, which might need some clarifying in a second. By the way, I wouldn't have actually said 10. I had to respond to your expectation of me. That's why I put in 10. You see how, look, I know this stuff. I eat this stuff for breakfast. No, thank you very much. I really enjoyed that. Thank you, Patrick. I like that run through. In fact, I wanted to ask something about that question right at the end. What is the risk in these trades? We'll come to that. Perhaps you want to put the previous slide back up. Now, we did have one, before I ask anyone if they have any questions, we did have one on the chat earlier from Elias. What are the best tools to keep up and analyze upcoming economic indicators? I don't know if that means some sort of software tool or what to look for or what to subscribe to, but how would you answer that question?
Yeah.
Before you do, sorry, I just want to say someone's asked, can you share the slides after? Everyone who's registered for this will get the slide deck and indeed a recording. BTRM admin will send that out to everyone who's registered for this, plus those who've watched today. So there's no problems on getting the slides and the recording. Patrick, on that question about keeping in touch.
Yeah, I like to do it the manual way, and it all goes back down to reaction. So just through recording in a simple Excel sheet, you could get all this automated, but I just quite like doing it myself. Every live event has a reaction. That could be a central bank announcement. It could be data, could be geopolitics, could be month end, anything really. And I like to, what I do is I record it in Excel, and I have very simple, because I'm kind of old fashioned, I record it all in Excel, and I write down a reaction, and I write down my thoughts. Should that have happened based on 15 years of data, or not, or why it happened, or what else moved? And then what I do is I've got these mini maps, which are really lovely, clean PDF documents where I've annotated all of the moves visually, and why they happened and why they didn't happen and all that stuff. And I have those, and I build up those quarterly mini maps to go with my Excel documents. And I love getting a massive table, and I spread them out, and I get my clients around, and I get my buddies around going, what do you think? And that for me is the best way, because you've got the empirical evidence on the Excel, but you've also got the visual evidence. Just really topically, dollar CAD was the perfect retrace or giving back all the gains or coming back from the lows on every bit of data, both on the US side and the Canadian side for Q1 this year. Without a doubt, it was a 97% or 96% deliver, and I was like, that's powerful. So obviously we capitalized on that. So that was the story for dollar CAD, for example. So really, it's probably not the best answer, but it's the old-fashioned way, basically.
I mean, that's very interesting. You do it sort of, how should I put it, manually. You're doing it manually. You said old-fashioned. I mean, but clearly it works for you. Others might have a more automated way to gather this, but yes, for you, that was an interesting answer. Now, does anyone else have any other questions? There's nothing else on the chat. Any questions that anyone would like to ask now? Feel free to unmute your mic if you wish to, and indeed your video if you wish to. No? Okay. They are indeed shy. Now, I have one or two questions that came to me as we go through the slides. The first one was the slide on the indicators that you don't take into account, or you don't really do anything with them. Now, my question when I saw the slides, but because I saw them beforehand, just very briefly beforehand, was I was thinking, oh, what? Because they don't have any, they're not pertinent. They don't move the markets the way they might. But I got the impression that the reason that you don't was because, as you said yourself, you can't trade them, or you don't trade them. Is that because it's a very short-term view? If anything comes out with balance of payments or the beige book, there's no short-term trade. Would you take them into account if you had a longer-term view? Or is it because it's a very day trade or an overnight trade? There's no short-term way to trade it, which is why you ignore it. What's the reason behind you not using them?
Yeah, it definitely is a really good question, and you're absolutely right, because that is where I'm cut from. But really, there are things that can be kicked into the grass later on, and they always kind of do. So it's like, well, either you can't nail it, or it's a variable like the OER split on CPI, or it's something that's so kind of woolly and kind of ethereal somewhat. It's like you can't nail it. The Trump trade of 2016, which I got involved in, you could nail that after Hillary lost. Dollar yen was 101. You know that victory speech, he was like, and the market just piled into that. So that was like solid. And that's why that was really important at the time. Now it's different. So for me, it is definitely what you're saying, Morad, but it's also like, if there is a massive problem with US debt, we're all in trouble. Like really?
Well, that's certainly true. Yes,
Yeah.
we need a whole separate webinar to talk about US debt levels. No, that's fair. I understand that. That's clear. Interestingly enough, I wonder. Again, probably don't have the time today. I wonder what your view would be on this year's election. Obviously, the result comes out in November. Is there a Trump trade on there if he wins or not? That's you probably need another hour to run me through that one.
No,
Actually,
I can tell you in 5 minutes if you want.
try four because I need one more minute to wrap up.
Okay, no problem. It's impossible to trade. Why?
Right. Okay.
Because you've got, say Trump wins, you've got more tax cuts, personal, more tax cuts, corporate, higher tariffs on imports on Chinese goods. Net of that, we don't know. Expiries in 2025. Kamala coming in, you've got less tax cuts on personal, less tax cuts on corporate, but less Chinese imports tariffs. So the net of those nets, we don't know. It's a huge variable. So impossible to trade right now. Same question in 4 weeks.
Okay, but possibly tradable the night of the results, the early morning for us, early hours for us, or later hours for us, when the results come out, possibly tradable there, depending on what it is, right?
I think you get a steepening of the curve if Trump gets in, and you saw a bit of that after the debate with Biden. You saw a bit of that, but then lukewarm on Taiwan. You've got risk off, dollar yen coming lower. So it's very hard.
I agree. It is. I mean, I personally wouldn't at this stage. I'm not sure I would any time, but
Yeah.
that's it. No. Okay. Now, the other question I had was when you asked at the end, what's the risk on these currency pairs? Now, I was actually thinking, the correlation deviator it unwinds, or there's something else. But your answer surprised me because your answer was, take Aussie Canadian, China, trade wars, etc. Now that's a more longer term view. So having earlier realize that it's all about trading the macro, which is more short term. Your answers on what the risk was of those trades made me think, well, that's more of a longer term impact. That currency relationship with whether Aussie appreciates or depreciates against Canadian dollar, that would play out over time. It wouldn't be a very instant. It wouldn't be a day trade. It wouldn't be an overnight trade. Because if there's some trade war with China, or China bans Aussie imports, for example, commodities exports, then that would weaken the Aussie, but that would play out over time, would it not? So I was intrigued that your answer to that seemed to imply a more longer term view than the more shorter term horizon that causes you to ignore some of those other indicators.
No, because the message really is how much is China going to export deflation. So their appetite for iron ore, which is waning, you see iron ore coming off really hard, really directly affects Aussie. It may not be showing right now, but it's very instant. And once that starts to unravel, you can really join the dots with, a so-called hawkish RBA. When the macro starts to soften, that could really accelerate. And you've got some of those legs moving that. And it can be, it's not a long-term thing. Or obviously, the key thing about, Australia's relationship with China, it's only about iron ore. Really?
Right. Okay. Not some of their agricultural. No, I guess not. Yeah.
Yeah. So obviously, what you're saying is, it can be very short term as well, basically.
Yeah. Okay. All right. No, it's very interesting. Okay. No. So I don't have any more questions myself. Does anyone have any last minute queries for Mr. Reid? Speak now, forever hold your peace, as my old Latin master used to say. Okay, well, in which case, all it leaves for me to do is thank you once again, Patrick. Really enjoyed it. Thank you for the presentation. I hope you enjoyed it, sir. Thank you to all of you who joined the call, joined the webinar. Just to confirm, you will get the recording and the slides. And, oh no, hold on. I've got a raised hand. I've got a thumbs up. That's fine. Thank you. Thank you to all of you. Pleasure, as always, from everyone at the BTRM. Thank you to Patrick. Thank you to everybody. And my name is Morad Chowdhury. I bid you a good evening, and we will see you again at the next webinar. Thanks, everybody. Have a good evening. Take care. Bye-bye.
Thank you, Morad. Take care. Nice to see everyone.